Gold is up 43% against the Canadian dollar over the last 5 years. Not in a crash. Not during hyperinflation. Not while banks failed or currency controls were imposed. It rose while employment reports stayed positive, while GDP figures were defended as resilient, while pension statements still projected 25 years of indexed payments. Most people missed it, not because the information was hidden, but because it didn't fit the narrative they'd been trained to watch for. Gold was supposed to matter during emergencies, when ATMs go dark, when governments freeze accounts, when the currency visibly collapses. It wasn't supposed to move during ordinary time, when mortgages reset on schedule and direct deposits still clear. But that 43% wasn't speculation. It was reallocation. It was capital deciding, and quietly and without drama, that Canada no longer offered enough productive return to justify the exposure, not because the country was failing in any traditional sense, but because the system had slowly reconfigured itself around preservation instead of growth, safety instead of opportunity, and asset protection instead of value creation. The gap between what Canadians believe their economy is and what capital increasingly treats it as has widened to the point where the divergence itself is now the story. And by the time that gap becomes visible to most people, the capital that could have closed it will already be gone. This is not about predicting a crash. It's about recognizing that the train has already started moving, and most Canadians are still standing on the platform waiting for a departure announcement that will never come. There was a time when the Canadian economic system made sense to the people living inside it. You worked, you saved, you contributed to the machine, and the machine returned something real. Not always fair, not always equal, but coherent enough that participation felt rational. Households provided labor and savings. Institutions recycled those savings into mortgages, business loans, infrastructure projects, and government financing. Banks earned stable margins. Pension funds assumed steady growth and reinvested accordingly. Governments expanded services without destabilizing the currency or the bond market. In return, Canadians received rising wages, appreciating assets, and a political system that mostly kept its promises. The model worked because capital had multiple productive outlets. The energy projects absorbed billions and employed thousands. Manufacturing still existed at scale. Housing expanded roughly in line with population, and income growth not ahead of it. Credit creation financed expansion, not substitution. When you borrowed, it was to build something or buy something that would generate future value, not just to service prior obligations. Most importantly, the system preserved optionality. If one sector slowed, capital rotated into another. If wages stagnated, people retrained or moved. If housing became expensive in Toronto, you could still build a life in Edmonton or Halifax without sacrificing income or access. The system bent under pressure, but it didn't trap you. Gold had a role in this environment, but a marginal one. It competed poorly with equities that paid dividends, businesses that generated cash flow, real estate that appreciated steadily, and bonds that offered predictable income. Holding gold meant accepting opportunity cost, and that cost was real. Most Canadians were right to avoid it. That trade-off no longer holds. The first distortion occurred in housing, but not the way most people think. It wasn't that prices rose, it was that they rose for the wrong reasons. Housing stopped being a consumption good that happened to appreciate and became a financial asset that happened to provide shelter. Regulatory frameworks made new construction slow and expensive. Municipal governments derived revenue from rising property values, creating an incentive to limit supply. Tax policy favored home ownership over renting and real estate investment over business formation. Mortgage lending became the safest, a most predictable revenue stream for banks, requiring minimal underwriting risk and offering implicit government backing. The result was that capital flowed into existing housing stock, not because it was productive, but because it was protected. Returns became dependent on price appreciation rather than use. Housing absorbed savings that could have funded startups, infrastructure, or productivity improvements. The system began rewarding ownership of what already existed rather than creation of what didn't. This might have been containable if housing were the only distortion. It wasn't. Institutional finance followed the same logic. Banks found mortgage lending and government bonds more attractive than business formation or innovation financing. Pension funds shifted toward low volatility assets with implicit guarantees rather than ventures with growth potential. Insurance companies and endowments did the same. The system trained capital to flow where risk was lowest, not where value creation was highest. Government policy reinforced this shift. As growth slowed, fiscal spending substituted for productivity. Debt expanded to stabilize outcomes rather than generate returns. Bond issuance crowded out private risk-taking while maintaining the illusion of normalcy. The role of institutions like the Bank of Canada shifted from discipline to stabilization, a rational response to political pressure, but one with long-term consequences. Demographics tightened the vice. An aging population increased demand for predictable income and asset stability. Pension systems, though including the Canada Pension Plan, became structurally dependent on asset appreciation rather than economic growth. Capital preservation replaced capital formation as the dominant objective. Once that shift occurred, any policy that threatened asset values became politically unthinkable. Geography concentrated the risk. In Toronto and Vancouver, housing valuations became so central to household balance sheets that policy flexibility collapsed. Median home prices reached 10 times median household income in some neighborhoods, turning housing into the primary determinant of financial security. Any meaningful correction would wipe out equity for millions of families, trigger defaults, and destabilize the banking system. Reversal became unthinkable not because it was economically impossible, but because it was politically suicidal. Each layer reinforced the next. Capital flowed where it was safest, not where it was most useful. Institutions optimized for balance sheet preservation rather than growth. Policy prioritized stability over correction. And households, trapped inside the system, defended the very distortions that constrained their futures. Over time, the system trained investors, domestic and foreign, to treat Canada as a yield preservation zone, not a growth engine. In that environment, gold stops being an inflation hedge and starts functioning as an exit ramp. There's a duplex in suburban Mississauga, built in the 1980s, listed at $1.4 million. It needs a new roof. The wiring is marginal. The layout is impractical for modern families. Comparable structures in peer cities might sell for $400,000. The difference isn't the building. It's the regulatory moat around supply, the tax treatment of primary residences, the mortgage credit extended against future appreciation, and the shared belief that prices cannot be allowed to fall. The owners are not speculators. They're a retired couple whose net worth is almost entirely embedded in that property. Their pension income covers daily expenses. The house is their financial security, their inheritance plan, their hedge against long-term care costs. They vote accordingly. Any policy that threatens housing values feels like an attack on their survival, and they're not wrong to feel that way. The system made them dependent on asset inflation, then made asset inflation a policy priority to protect them. This is not villainy. It's incentive logic playing out at scale. Most people interpret gold through an outdated mental model. They think it matters during currency collapse, hyperinflation, or systemic banking failure. That's not wrong historically, but it's incomplete. Gold also moves, quietly, steadily, when capital loses confidence that domestic systems will treat it fairly over time. The question is not whether Canada will experience a sudden crisis. The question is whether holding Canadian dollar-denominated assets offers enough productive return to justify the political, regulatory, and demographic risks embedded in the system. Increasingly, capital is answering no. This shows up in portfolio allocation decisions that never make headlines. A pension fund shifts 2% of its holdings into physical gold or gold-backed ETFs. A high-net-worth family diversifies part of their wealth into foreign assets and hard stores of value. A small business owner keeps more cash in USD or gold rather than reinvesting locally. None of these decisions are dramatic. Individually, they're barely noticeable, but they compound. Gold does not generate cash flow. It does not pay dividends. It cannot be used as collateral the way real estate can. Holding it means accepting that you will not participate in growth. That trade-off only makes sense if you believe growth is no longer likely, or that the returns from growth will be confiscated, taxed, or inflated away faster than they accrue. Canada has not imposed capital controls. It has not defaulted on debt. It has not printed currency into oblivion. But capital is pricing in the possibility that future policy will favor incumbents, redistribute returns, and penalize mobility. When that expectation sets in, even moderate savers begin treating gold not as a speculative bet, but as a rational insurance position. The signal is not that Canada is collapsing, it's that Canada is no longer competing effectively for capital deployment. The policy response has been predictable. Governments attempt to make housing more accessible without reducing prices. They increase immigration to sustain demand and labor supply. But infrastructure and housing stock don't expand proportionally. They introduce first-time buyer incentives that effectively subsidize sellers. They tighten lending standards, which reduces access but doesn't reduce valuations. They freeze interest rates low, then raise them suddenly, shifting the burden from asset holders to recent entrants. Each intervention stabilizes one part of the system while destabilizing another. Housing support props valuations but discourages new entrants. Immigration sustains GDP growth but amplifies housing shortages and wage suppression in lower-skilled sectors. Debt issuance maintains government services but crowds out private investment. Rate adjustments shift pain between cohorts without restoring productivity. The pattern is not accidental. It reflects the reality that policymakers are trapped between constituencies with incompatible interests. Homeowners demand price stability. Renters demand affordability. Pensioners demand returns. Workers demand wage growth. Businesses demand cost containment. Governments need revenue without triggering capital flight. There is no policy mix that satisfies all of these simultaneously. Every choice involves picking winners and losers. And because the political system rewards short-term stability over long-term adjustment, the path of least resistance is to delay, obscure, and manage decline incrementally. This is the same pattern that appeared in Japan after 1990, not as a sudden collapse, but as a slow freezing of capital into unproductive safety. Asset prices stagnated, debt accumulated, innovation slowed, young people delayed family formation, corporations prioritized survival over expansion. The economy didn't crash, it just stopped growing. The warning is not deflation, it's immobilization. Gold's rise is not a forecast of disaster, it's a referendum on optionality. Capital is voting that Canada offers fewer paths to productive return than it once did. And the vote is increasingly unanimous, not just from foreign investors, but from domestic institutions, family offices, and individual savers who have spent their entire lives contributing to the system and are now quietly diversifying out of it. This doesn't require panic. It requires pattern recognition. And once you see the pattern, it's hard to unsee. The constraint wall appears gradually, then all at once. Policymakers face a grid of bad options. Tightening credit risks, triggering housing corrections that would destabilize household balance sheets and bank capital ratios. Cutting government spending destabilizes debt servicing and reduces the fiscal buffer against recession. Raising taxes accelerates capital flight and reduces investment incentives. Doing nothing extends stagnation and allows misallocation to deepen. Every option has a cost, and because the costs are immediate while the benefits are distant and uncertain, the political incentive is to choose inaction. Voters are trapped for different reasons. Their wealth is embedded in the very assets causing the problem. Housing appreciation feels like prosperity even as it erodes affordability for their children. Pension stability depends on asset inflation, not wage growth or productivity improvements. Any correction feels like personal loss, even if it would improve long-term outcomes. Younger cohorts are trapped because they lack the accumulated capital to weather corrections or the income growth to close the gap. Wage growth has not kept pace with asset appreciation. Educational credentials that once guaranteed mobility now result in debt without corresponding income. Geographic mobility is constrained by housing costs in productive cities and lack of opportunity in affordable ones. As capital is trapped because exit is costly and politically sensitive, until it isn't. At the margin, capital reallocates quietly. Gold does not require permission. It does not trigger headlines. It does not involve selling a family home or liquidating a business. It simply sits in a portfolio, inert and unproductive, representing a bet that doing nothing domestically is safer than doing something. This is the no good option zone. Stability without progress, growth without productivity, wealth without renewal. And once a system enters this zone, escape requires either external shock or internal willingness to absorb pain that the political system has been structured to avoid. There's a financial advisory practice in Oakville where the average client is 58 years old, holds $1.2 million in net worth, and is allocated 90% to Canadian equities and real estate. 5 years ago, clients asked about growth strategies. Now they ask about wealth preservation. The questions have shifted from what will generate returns to what can't be taken away. The advisors are not alarmists. They're responding rationally to client demand. But the aggregate effect is that capital is being reallocated defensively across an entire generation. Pension funds, insurance portfolios, endowments, and private wealth are all moving in the same direction, away from domestic risk toward inert safety. No single decision causes systemic harm, but the sum of rational individual decisions is a system that starves itself of the capital necessary for renewal. If the current trajectory continues, the future is not collapse, but stratification. Those with existing assets adapt by insulating wealth. They hold property, diversify internationally, shift into hard assets, and reduce exposure to domestic policy risk. Their balance sheets remain stable even as the broader system stagnates. Institutions adjust assumptions downward while maintaining procedural appearances. Pension funds lower expected returns from 7% to 5%, then to 4%. Banks tighten lending standards while maintaining profitability through fee income. Governments extend timelines for infrastructure projects and adjust deficit projections. None of this looks like failure from inside the system. It looks like prudent management. Younger cohorts, lacking accumulated capital, face a different reality. They delay family formation because housing is unaffordable. They extend education to credential stack, accumulating debt without corresponding income growth. They reduce savings because discretionary income is absorbed by rent and necessities. They migrate to cheaper regions or exit the country entirely, seeking systems where effort still translates into mobility. This is not a moral judgment. It's a description of what capital does when domestic returns no longer justify domestic exposure. Productive risk continues to lose the incentive battle. Entrepreneurship declines because the returns to starting a business cannot compete with the returns to holding property. Innovation slows because the regulatory and capital environment favors incumbents. Infrastructure remains underfunded because voters prioritize services over capacity expansion. Energy projects stall because political risk exceeds financial return. The economy does not shrink in nominal terms. GDP may even continue to rise, driven by population growth and government spending, but GDP per capita stagnates. Productivity growth flatlines. Median household formation rates decline. The system maintains the appearance of function while quietly eroding the conditions necessary for renewal. Gold does not win in this scenario. It simply becomes the asset that loses the least. It offers no growth, no income, no utility, but it also offers no political exposure, no confiscation risk, and no dependence on policy competence. In a system where every other asset class carries embedded risk that participants are increasingly unwilling to bear, gold's inertness becomes its value proposition. The station does not close. The trains do not stop running. Announcements continue to reassure passengers that service is normal. But the departures board quietly updates. Destinations are removed, frequencies are reduced, and one by one, those who can leave choose different routes. This is not a story about Canadians making bad decisions. It's a story about a system that trained people to make decisions that were individually rational but collectively destructive. It rewarded asset ownership over contribution. It protected incumbents over entrants. It prioritized stability over correction. And it did so for so long that reversing course now would require accepting losses that no political coalition is willing to impose. Gold's rise is not evidence of irrationality. It's evidence that capital is doing what it always does, seeking the best available return adjusted for risk. And increasingly, the best available return in Canada is preservation, not growth. Most Canadians are still standing on the platform because nothing looks broken. Employment numbers are defended as resilient. Housing values are protected. Pensions are projected to remain solvent. Banks report strong balance sheets. The currency hasn't collapsed. There are no visible crises. But visibility is not the same as absence. The capital that could have funded the next generation of businesses, infrastructure, and opportunity is quietly reallocating, not into productive domestic investment, but into inert stores of value that offer no benefit to the system but cannot be confiscated by it. The decision is being made in portfolios. So pension allocations and family wealth strategies, 1% here, 2% there, until the cumulative effect is that the system no longer has access to the capital it needs to renew itself. By the time the absence is felt, the reallocation will already be complete. The train has left the station. Most Canadians just haven't looked up yet.